Welcome to Investing with IBD podcast, sponsored by North Coast. I'm Justin Nielsen, your host, and it's Wednesday, September 29th, 2021. And as always, I'm joined by Arusha Piras, O'Neill Global Advisors, Portfolio Manager. Welcome back, Arusha. Thanks for being here.
Hey, great to be here, Justin.
And we have a really special guest today, Mark Minervini. Talk about someone that just really knows his stuff. This is an author of books on stock market trading, like Trade Like a Stock Market Wizard and Think and Trade Like a Champion. He's also the founder of Minervini Private Access. He's a U.S. investing champion on his way to maybe getting another championship under his belt. And, I'm checking my notes, and it also says he's a generally nice guy. That was something that just got added in. So, Mark Minervini, welcome back to the show. Thanks for being here.
You got 3 out of 4 of those right, so that's
okay. And people can do their own research and figure out which one was the one that didn't belong. So on today's show, we're going to be talking to Mark a little bit about the market, how he's been handling it, and specifically how he's been not only reducing his drawdowns, but still making progress in a market that has been very difficult, and really what kind of leads to his success. And that's really discipline and sacrifice, two things that are very hard to do, easy to talk about, but hard to do. And of course, we'll be talking a lot about stocks. This one's going to be a little bit more chart heavy. So for those of you that, are maybe listening to this on your car ride, maybe you want to check out the show notes afterwards and see some of the charts that we're talking about, because Mark is going to be leading the charge and showing charts to us. Arusha gets a break from flashing the charts himself. So let's get right into it. Mark, where do you want to start? Do you want to start with the market and talk a little bit about the difficulties, I guess, that the indexes have been having lately? Are we in a correction? The indexes have been going up, but it hasn't necessarily translated to a lot of portfolios.
Yeah. Well, I think we're in a correction, at least in individual stocks, at least in some sectors and some areas in the market. And depending what you look at, first of all, you have S&P 500. You've got S&P stocks. More than 80% of them have already corrected 10% or more. And more telling is the percentage of stocks below their 200-day, or I should say above their 200-day moving average, and the NASDAQ, which is only at about 36%. So you're looking at 2/3 of the market is already, or at least the NASDAQ is already below its 200-day long-term moving average. So right there, that would tell you that you're in somewhat of a correction in NASDAQ stocks as far as the individual stocks are concerned. But you're just not seeing it. You're not seeing it in the indexes yet.
So going a little bit more into that, where you have the indexes still kind of slowly trending higher underneath the surface, 2/3 or below the 200-day. What's so important about that divergence?
Well, of course, you're looking at an index. When you look at the S&P 500, there are 500 names. They're capitalization weighted. So really, there's just a handful of names that are affecting that. When you look at the Dow, there's only 30 stocks, and they're price weighted. So Qs, of course, are all these big mega cap companies account for a big portion of these indexes. So you're not really getting a really fair representation of the broad market. So when you look at the individual stocks are equally weighted, and you look at the percentage of stocks, above their 200, and the index is far above the 200, but you've only got 36% above the 200-day, that tells you that the ice is melting beneath your feet.
Right. And that kind of seems like it's a do you feel lucky punk? Do you think that you're good enough to get the 36% that are still above the 200, or are you finding yourself in the other, the majority at this point? But looking at the S&P 500, I think one of the things that's again, as we were talking about, that's been a little bit deceiving is it seems like there's been this buy on the dip mentality. The S&P 500 keeps on coming back to its 50-day moving average line, getting support. But after like the 8th or 9th time, you got to wonder how long can that go? And it certainly seems like it's, for the first time, spending some time below that 50-day moving average line now.
This is a similar situation that happened in 2018, where the market had very little volatility for a long period of time and just kept meeting support on every little pullback. I think Justin, the statistic better than me, just a couple percent, right? It went along, how many days?
Yeah, it was like, I think 3.4% was the biggest correction for like 400 days or something like that.
Yeah.
It's starting in 2016 and ending at the beginning of 2018.
Yeah, and then it rolled over pretty hard, and that's what usually happens when you get that lack of volatility for an extended period of time. Eventually, you pay the piper, and it conditions everybody to keep buying those dips, and then before you know it, of course, the dip that keeps on dipping comes. So the question is, are we there? Have we played this out, and is this going to be the pullback that pulls back even more? It's looking more and more like that might be the case this time.
And as you mentioned, I mean, it's also a seasonally weak, time period. We're right in the middle of volatility, and very similar to the Q4 of 2018. Fast forward to after that low volatility period. At the end of 2018, we kind of had a little bit of a Fed concern. What was going to be going on with the Fed, and that seems to be rearing its head as the 10-year Treasury yield has been, jumping pretty spectacularly lately. So there's those issues too, right?
Yeah, well, two things. One, I think it was Kevin Marter that recently said, I'll paraphrase, but when you've been doing this for a while, you learn to respect the September, October, November period. And this is definitely a period where you have volatility, and going into it, it's a seasonally weak period. So that's seasonality. I don't trade on seasonality, but I am aware of it. As far as the Fed's concerned, I'm pretty surprised that, and I think maybe the reality is starting to set in here. I thought the Fed news of talking about tapering, sooner was not great news. So market handling it well was definitely something that I want to see, but again, I'm going to wait to see if we get a hangover from it. And now it looks like we are, and the 10-year as well is starting to surge a bit. So that could be where we and then maybe we'll blame Evergrande or something. That'll be the scapegoat. But I think it's more based on interest rates and the Fed.
Mm-hmm. Well, that's a lot to cover right now just with the market. We can go ahead and take a quick break. And then when we come back, we're going to get a little bit deeper into your discipline, your sacrifice, and everything that's making you a great trader and U.S. investing champion. Stay tuned. We'll be right back.
To help alleviate some of the pain that comes from bear markets, we recommend investing 20 to 25% of the equity portion of your portfolio in a tactical strategy. If you're especially risk-averse, we recommend a higher percentage. In 2008, the market declined 37%, yet our portfolio was only down 12%. Why? Because the conditions for investing were poor, so we held a lot of cash. Visit northcoastam.com/tactical.
All investments involve risk, including loss of some or all of an investment. May not be suitable for all investors. Past results do not guarantee future performance. Okay, welcome back to Investing with IBD podcast, sponsored by North Coast. We have Arusha Pires, along with myself, Justin Nielsen, as your host, and our special guest, Mark Minervini. So, Mark, you were talking a little bit about how there really has been a correction kind of in place for a while now. And maybe if we start by just pulling up the S&P 500 or the NASDAQ, either one, and maybe you could walk us through a little bit about how you've been handling your own portfolio, because at least on the U.S. Investing Championship, what you're in the money manager division, million plus, right now?
Yes.
Yeah. So you really haven't been giving up any ground whatsoever, even though the NASDAQ was basically in a little bit of a correction for mid-February for months and months, just a correction through time. The S&P 500, it's been doing its pullbacks, getting to new highs, but now it's trading below the 50-day moving average line. How have you been handling this market?
Yeah, so I should just point out, I'm in the money manager division, the $1 million plus, but I'm not managing other people's money. So it's it's my own personal account. I put up my own personal money just to make that clear.
Good clarification.
Yeah, but how I've been handling it, going all the way back to January, February-ish, I started noticing that we were getting 1, 2, 3 days of rally out of these breakouts, and then they would fail, and they come crashing in, and either they were stopping me out at break even many times, or even hitting stops, and I was losing money on trades. So I made an adjustment. I said, I'm just going to sell these stocks right into this first rally. And it worked so perfectly that I've kept doing it and
kept doing
haven't
what's working
stopped since.
Right.
I think there's been a real opportunity here, and some people have on Twitter and social media have asked me many times if I changed my strategy or what I'm doing differently. I'm not really doing anything differently, except I'm selling sooner and I'm adjusting my stop accordingly based on that risk reward profile. But I should point out that I'm not like day trading from 1 minute or 5 minute charts and changing anything. I'm still buying the breakouts from bases that I'd be buying if I was buying for a swing trade, or even if I was going to hold it for a year or more. The unique situation that's taken place for the last, I'd say, 8 months now has been you just keep getting setup after setup after setup of these fairly good sized bases, and you get these breakouts that you would think would be great for a swing trade or long-term hold, but they don't. They come back in very quickly, and there's volatility around the pivot point. But the opportunity is that they do rally for a couple of days, and they're giving you these short-term opportunities over and over and over. So I've just been capturing them and compounding the money, rolling it over. Now, if there were no setups, on the daily charts, I'd be flat right now. I mean, I wouldn't be doing anything. So I don't switch. And if, swing trading is not working and those setups aren't there, I don't switch to day trading and start using intraday charts. I'm using the same daily charts.
Mark, so talk about a period or just where you were flat for a while, where you just didn't see setups and you had the discipline, because most people listening to this, they're not going to have the discipline, right?
When you're not doing well, your timing's off, and it could stay off for a while. Or the market might be just entering a correction, or it could be a stealth correction like we have now. And you're looking at the indexes going, wait a minute, everything's fine. But in fact, the market's correcting beneath the surface, and the signs are there. So what I do, is if I'm having trouble, I come down to very small trading. I take my position sizing way down, my exposure down, and if that's not working, I just go to cash, and then I watch and I wait till things start working. So I'm like a caboose, and the market's the engine. I'm always following. I'm never trying to guess. And when you're doing this for 37 years and you've had a degree of success, it's very easy to get cocky. So you have to be careful that you don't get arrogant and start thinking that you know something, and they start guessing and front running your research. But your question you asked was, period where I stayed out, and this is what I call sit out power.
Yes.
Now, this is the real. Actually, sit out power is probably takes more discipline than being disciplined to buy and institute a lot of the rules to trade stocks, because most people, they're dying to trade. They want to get in there and get that action. But sitting out is really what's most important. And we talked about this before the show, that O'Neill. I met Bill O'Neill many years ago, and I'll paraphrase, but he convinced me about one thing. He said, when you're doing nothing, the undisciplined and the unskilled are laying the groundwork for your success. And that it was a fortune in that statement. And I took that to heart. And 1993, mid 93, I didn't make much, but a couple trades all the way until almost April of 95.
Wow.
Wow.
I went, it was like 2 years of just doing almost nothing, because just nothing was setting up and nothing was working. Then when the market rolled over in 2000, went into 2001, it really got nasty. I was out pretty much, with the exception of I was actually short on 9/11, which fortunately for me, but it was sort of what was it in Wall Street? Sir Larry Wildman going off of a cliff in my new Maserati. It was sort of, that, because it was such a horrible time. And I had friends that, perished in the world trade. But back then, the only stocks that were setting up were defense stocks, and the market was rolling over, and I was short, and I was actually thinking about going long defense stocks, which again, that just tells you about the intelligence in the market.
Incredible.
Defense stocks were setting up, and the market was rolling over just before 9/11. Something to think about. I always said if I was short defense stocks and long, the FBI would have probably showed up and said,
Exactly.
I know something about this pending attack. So, that was a period where I was out for another, it was like 2-year period where I did very little, some shorting, and there was just no longs that were setting up. Then 08, 09, when we rolled over into 08, going out, even after we bottomed in 09, it was treacherous. I think that's probably the most difficult market that I've ever traded, was coming off the 09 bottom. It just wasn't like most bear market bottoms where the leaders set up and you get it right and you're off to the races. That was like, wow, it was just all over the place, volatility, and it took a while before you could get your footing.
Well, growth, it seemed like it took months to catch on after that bottom. It was really the value plays, because remember, Bank of America and Ford and Citigroup, they were all trading like around a few bucks,
right?
So it was those bounces from the things that were beaten down so hard that was really driving the indexes for a while. And I absolutely agree with you. That was a very different market environment.
During that period, I had to actually make a little bit of an adjustment to my parameters, because I don't buy stocks below $12. And at that particular time, like, it was like everything was below $12
until they started reverse splitting.
Like some of the biggest, most well-respected companies in the world were trading like, penny stocks and single-digit numbers, prices. So it was a very strange environment back then.
Yeah. Well, and really, it sounds like what it comes down to, just to kind of wrap this up a little bit, is you're listening to the market. You're not trying to do those revenge trades. When the market tells you something very clearly, you don't get that sense of, well, I know better, or I'll show you type thing. It's really just, paying attention to the statistics that you have, the what's happening in your trading, what's happening in the market, and letting the market be your guide.
There's 2 words that if you don't come to know and love and live, you're going to have a tough time in the market and probably not a very good career. Those 2 words are respect, risk. So you have to respect risk at all times. And again, like I said, after a while, you have success and you start getting sloppy and you think it's easy. And that's when things can go really, really bad. Usually you get your biggest or your worst beatings come after your biggest successes. So that's when you really got to get your guard up.
And in terms of cutting losses, what is it that you do to make sure you're always minimizing your risk? A lot of people look at, ways in which they reduce risk by, I'm not going to trade right before earnings, or I'm not going to, be buying, breakouts because, breakouts are failing. What is your best way of reducing risk? And I know you've wrote a couple books on this, so it's not something you're necessarily going to be able to say in a few words, but anything that sticks out to you?
Well, as far as reducing risk is concerned, I'm always, losses are a function of expected gain. So I'm always trying to get a handle on what I can expect on the upside. So for instance, in this most recent period, my upside has been a lot less because stocks are just not giving us that upside. So now I've got to make up for that. I've got to now truncate or shorten my losses to make up for that. So I'm always measuring what I'm pulling out of the market on average on the gain side. And then I don't want to risk any more than I want to have a 2 to 1. So I want to be risking 50 cents for $1. I'd like to have a 3 to 1. That's what I'm really shooting for. But at a bare minimum, I want a 2 to 1. So if I'm pulling 8% out of the market, I can't take 8% losses. The 8% max stop rule is going to be off the table at that time. And I'm going to have to average less than that. If I'm averaging 8%, and even if I'm right, let's say 50% of the time. Now, if I'm right less than 50% of the time, this is a period where I'll bet most of the viewers here, if they went back and they looked at their trading in the last 6 or 8 months, I'll bet you their batting average is really low. Even if you're maintaining that ratio and you're cutting your losses in relation to your gains, it's probably a period where your batting average is low and probably in the 30s. And that's because of the whipsaw. That's the whipsaw environment, which the other thing about managing risk is you have to realize that people think a bear market is it's dangerous to go into a correction. Actually, no, the sideways market is the most dangerous market for a breakout trader that uses tight stops, because that's where you get whipped in and out, and you get death by 1,000 cuts. When you roll over, you go into a bear market, everything stops you out, nothing sets up, and that's it. You're in cash. That's, we'd love to have it where the market rolls over, knocks you out everything, and then has a big correction. That would make it real easy. But it's these whipsaw markets that are really the ones that you have to survive. And what I do is, if things aren't working and if my trading's not working and I'm not producing profits, I sit out and I wait it out. And I'll go in with little pilot buys and just to keep my finger on the pulse and put my toe in the water until that's working. I don't get aggressive. I never get aggressive until I'm having those pilot buys and those smaller buys work. And then I'll start increasing my exposure. So one of the things about managing risk is to work with profits. And before you get aggressive, if you're not profitable at 25%, there's no reason to go to 50% exposure. If you're not profitable at 50% exposure, there's no reason to go to 75 or 100. There's no intelligent reason whatsoever to be raising your exposure when you're not profitable. And one of the ways to look at that is to just look at your last 5 trades. Have your last 5 trades made money on balance? And if not, maybe you try another 4 or 5 trades. Have those trades made money on balance? If your answer is no, and you came into the market a couple of times and took 3, 4, 5 trades, and you're not making money, then right there, that gives you all the information you need to know about whether things are working or not, and you should be getting aggressive.
But another thing that I think is interesting about the math involved, and there is some math here, that you have those ratios of your risk reward set up to such a point where you can be wrong a lot and still make a fortune. So how is it that you do that? And maybe share some statistics, because I think people would be surprised with how many losing trades you can have and still come out so far ahead.
Yeah, I have lots of losing trades, but my losses are very small in relation to my gains.
Right.
So as far as the math is concerned, and we talked about this a little bit earlier. What I did back when I first started trading, I wanted to figure out how all the trading rules, and I went to O'Neill seminars and so forth, and even David Ryan, who now trains with me at the Master Trader Program. I was going to see David Ryan 30 years ago and learning. But once I got that and I started understanding how to apply the buy rules and the stop losses, I wanted to really dig in and get behind the actual mathematics of it. And I started using a lot of techniques or a lot of an approach like futures traders did, where they really got mathematical about it. And I just started getting obsessed with my statistics and measuring everything. How many days I hold my winners, how many days I hold my losers, what's my maximum drawdown, what's my, what's my average drawdown from peak, what I'm giving, that's my give back, what my average gain is, my average loss, my ratio adjusted for batting average, all the statistics. And I just started, what happened is as I started trading, I realized that when you do that, it makes its way into your trading. Now, I'll give you an example. This is like really key. Once you start doing your numbers and you're aware, so let's just say you've done your average, you know what your average gain is. You look at your last 100 trades, your average gain is 8.9%, let's say. Okay, so now you're in there, you're making a trade, stock starts going against you. It's down 4%, it's down 5%, it's down 6%. The little bell that goes off in your head, you start thinking, wow, my average gain is 8.9. I can't let this trade go bigger than 8.9 or I'm losing. Right. And that's if you're right 50% of the time. So, and if you're having trouble and your batting average is lower than that, well, that number is even lower. So now you're thinking, you're trading, and you're thinking based on the math. You're letting the math come into your trading, and you have this awareness, and it improves your trading. And that's where things really started to change for me, where I started making decisions. All my decisions became mathematical decisions, just like in a poker game. You've got $50 into the pot. You don't bet $500 into a $50 pot. Now you're laying 10-to-1 odds. But if there was a $500 pot and you bet $50 in it, now you're getting 10-to-1 odds. So you have to always be thinking risk versus reward. And the main rule that I have is always get odds on your money.
one thing is, and you started the whole episode out with this, where early this year you were taking quick profits and you learned, okay, that's the strategy. Now, there's something about sacrifice, right? Where you're taking those quick profits, but you're giving up those big gains. Talk a little bit more about that, because a lot of times people want both things. They want both the quick profits, but then they want to hold on to the big winners.
Okay, so two things. One, how this actually started was I wasn't taking quick profits, and I'm holding them, and then I'm giving it all back. So that's how it actually started, where so now I'm holding the stocks, trying to play for a swing move, and then I'm realizing, whoa, I could have captured a nice 8%, 10%, 12% move in 3 days. And I started noticing that stock after stock after stock were breaking out, but they the natural reaction that some of you who know me, you can read about this in my books. Then going through that first natural reaction wasn't natural. It wasn't, the stocks weren't pulling back and then going back into high ground. They're pulling back and then pulling back more and then stopping me out. So that was the first observation. So then I switched over and I changed. Now, to your point, the word is sacrifice. You have to be willing to sacrifice in all things. I mean, if you were to become a sports player, you're going to play baseball. You're certainly not going to be a great baseball player and basketball player and hockey player, right? You're going to put your life into a particular sport and that you love or profession or business, and specialists get paid really well if you become really great at something. So again, you have to sacrifice, and it's probably a good time to show maybe some charts of some of the stocks that I bought. And it sounds great that okay, you bought these stocks and they went up and you capture those quick profits, but there's a lot of times where I took that profit in 2 days and the stock went up and doubled.
Right.
So in order to capture that small profit, you've got to give up the big move.
Right.
And to get the big move, you might have to go through pullbacks that give you're up 8 or 10%, and now you're playing it for a bigger move. Stock comes all the way back, stops you out, and now you could have taken the 8 or 10%. So this leads into that Monday morning quarterbacking, regret. I should have, could have,
should have, could have, would have.
Right. You have to go in with a plan, execute that plan, and then realize that is at the cost. There's always a cost. Every plan's going to have a cost. So you can't be everything. So make a decision. I made a decision that I'm going to go with this until the market tells me that there's a better option on the table.
Mm-hmm. Yeah. So a couple of the ones that we were talking about, I mean, like Moderna, let's brought that up, ticker symbol MRNA. This has been one of the darlings of the vaccines. So go ahead and walk us through how you handled this one.
So Moderna, I bought right here on the 29th. Let me just make sure that's right. Yeah, 29th. I bought this right here on the 29th. I sold it on the 30th, the very next day. I sold it on the 30th. Now, again, for a couple of days, I guess I was right. But then look at this. Look what I left on the table. Then it went up 100%. All right. So, but I'm up 200 and whatever it is, 63% right now for the year. I think it's a little more now, 270% for the year.
So you're doing okay.
So I'm doing okay, but again, see, I got there with sticking to a plan.
Yes.
You can get there, you can get there by having a big mover, or you can get there by trading and having a lot of trades that you compound. But my plan was to capture this is an aberration, first of all, because most of the stocks that I've been trading, if I didn't sell in 2 or 3 days, they just come back down and stop me out, and I've been losing money. It's just the batting average is just too low on the swing trade side again, every now and then you're going to get these moves, but does the reward pay for the risk? That's the key. Is the reward paying for the risk? How much risk are you taking? And that's just not with stop losses. That's with how many trades are working. And there just weren't enough trades working to justify trying to get this type of move. But this is, of course, certainly painful to watch after you sell it.
Sure.
Right. Well, and I think, you recognized that this was an aberration. You looked at all your trades and you're like, okay, this is what's working for me. Yes, I left, money on the table in this case, but if you would, I think what happens with a lot of people is they switch because of the aberration, and it ruins their entire trading plan.
Yeah, well, you're always going to get a reason to switch.
Yeah.
Every day the market will justify just about anything. I used to say, if you were to watch beetles scurrying around long enough, and you'd probably figure out some pattern that would correspond with the market.
Right.
You could say, you know, when they do this, the market rallies, and you know, the football indicator and all these
Oh
things.
yeah.
You know,
I
there's
think
so many.
Chris Gessel came up with like a Laker indicator back in the early 2000s when the Lakers were, you know, hey, when they do a three-peat, I mean, that's
hilarious.
You can back into just about any rationalization in the market on any one day. That's why discipline is so important. I know that people have been saying, you know, they say, oh, if everybody reads your books. Now, I heard them say this to O'Neill, by the way, and I'm sure they said it to Jesse Livermore too in the 1930s. I remember, you know, people saying to O'Neill, and this is, you know, 30 years ago, if everybody does this, wouldn't it make it not work? You know, and then of course I made an entire career on those principles going forward for the next 30 years. And now they say the same thing to me. You know, if everybody reads your book and they do it, trust me, everybody's not going to do it. and even if everybody wants to do it, very few are going to have the passion to be able to really stick with it, and even fewer are going to have the discipline to actually do it and do it correctly, and to have the discipline. So again, you know, you can rationalize so easily in the market, but you got to have that discipline.
Well, when we come back, we are going to take a look at some of the charts that have made your year, or what you've learned from them, and what you can share those lessons with our audience. So stay tuned. We'll be right back.
To help alleviate some of the pain that comes from bear markets, we recommend investing 20 to 25% of the equity portion of your portfolio in a tactical strategy. If you're especially risk-averse, we recommend a higher percentage. In 2008, the market declined 37%, yet our portfolio was only down 12%. Why? Because the conditions for investing were poor, so we held a lot of cash. Visit northcoastam.com/tactical.
All investments involve risk, including loss of some or all of an investment. May not be suitable for all investors. Past results do not guarantee future performance. Welcome back to the Investing with IBD podcast, sponsored by North Coast. It's Justin Nielsen, your host, along with Arusha Paris and our special guest, Mark Minervini. So, Mark, before we get into some charts, and you've got a lot of charts to show us, you've got a master trader program that's coming up. And Arusha, I know you've been there, so maybe you can start talking a little bit about your experience, and we can have Mark fill in some details for us.
Yeah, no. So I was a director of MarketSmith for many years, and a few years ago, we were proud to support Mark and the Master Trader program. And so I had a chance to go to the live events the last two times they did it live, and it's an amazing program. It's Mark's life work, and I'm taking some of your lines, Mark, here. But 3 days we were there, and I was just amazed that Mark would stand up on stage for 10 to 12 hours and just answer every question, walk through every step of his process, and go over example over example. It's an amazing experience. Now, the cool thing is, you know, because we would have tons of people coming to Myrtle Beach. Now you can just watch it online, get immersed online, and still get the same experience. So Mark, talk a little bit about it, because it really is your life work.
Yeah, well, it was a 3-day event live, but now it's actually 5 days. There's 4 days of curriculum. There's a day of live trading with myself, David Ryan, Mark Ritchie, that you've read in Momentum Masters. A whole bunch of us are there. And we're also adding midweek, we're adding in some days with some special guests and a Q&A session. So it's actually going to be 7 days. And the coolest part of this, and I've said this many times, but you know, working with David Ryan has just been amazing. He's been with me now for like 8 years. But you know, I went to O'Neill seminars and went and saw David when, you know, 30 years ago. But what's even more just great for me this year is that we've added in Larry Height is going to be speaking. He's a special guest, and he was in, of course, the first Market Wizards, and he is really was instrumental in being a mentor that he didn't even know, but the Market Wizards books were like my Bibles at the time. And then of Tom Basso, who's also, he's a guest, going to be a guest speaker, and he was in Market Wizards too, of course. Stan Weinstein, who
Wow.
Yep. Yeah. And Stan, I met Stan in 1990 and met him in New York City and had lunch with him. And he explained to me about the 4 stages. And that's how I got into the stage 2 uptrend. And I started adding some, elements and turned on my computers and studied that and found that he was absolutely correct that the big moves happened in that stage 2. So yeah. And then of course, Mark Ritchie as well, who is, in my opinion, a modern day market wizard. He's featured in Momentum Masters. So it's just, this is the biggest event that we've ever had. So it's really going to be special, and it's online, so anybody in the world can attend.
So Mark, when is it and how do people find more information about it?
Okay. I always don't know the date exactly. I think it's November 13th. It starts on November 13th. It's either 13th or the 14th, and it goes for 2 days. And then in midweek, we have those guest sessions, and then it's the next weekend, which would be 2 more days of curriculum. And then that Monday, we do a full day of live trading. And then, of course, you're going to be there, Arusha, and going over MarketSmith. And we what we do with MarketSmith is we actually show how David and myself, how we screen and using MarketSmith. And then and Arusha always teaches us something new about using MarketSmith. Every year I learn something more about how to utilize the tool itself.
So Minervini.com, they can just go to the website there and get information?
For the workshop, it's the letter 4, stocktraders.com.
Okay.
Yep.
Perfect. And that's just, again, a lot of people don't realize that, hey, look, this takes work. It takes educating yourself. And what makes it easier is when you can learn from people that have been very successful at it. And it sounds like you have a whole host of people to kind of offer your attendees in addition to yourself and David Ryan. So let's get into some of the lessons, and again, it's not going to be 7 days. We're going to, try and pack as much as we can into our remaining segment here. But maybe you could share your screen and talk about some of the stocks that have struck you as, giving some good lessons about this market and maybe what's on your radar right now. Do you see anything setting up currently?
Well, I mean, as far as currently, not really.
Not really.
No, not a whole lot. There's maybe a few things. I mean, I'm right now we're long Tesla. That was just bought just a couple of days ago. This is a pretty large base here. I don't know. This stock is starting to look late stage here, but they seem to they keep resetting and going higher here. So I tried to play this coming out right here. But again, I'm also short the S&P from 9/13. September 13th is when I put that short on. And even with this most recent rally, I actually added to it. So I'm short and I'm mostly in cash, just long, just a couple names here. But on the one that we bought recently and has really worked quite nicely. And if we were coming out of a bear market, this would be like the absolute quintessential setup. It's virtually perfect in all ways. So I think this is a really good model. Even if it failed, it would be a good model of something that, looked perfect and then failed. But again, this Penske Automotive, I actually bought it right here. And you can see that's on 9/1. So it tightened up quite nicely, had my signature VCP characteristics, which are just within a cup with handle. So
and for people that don't know, what does VCP stand for?
So volatility contraction pattern. And this is sort of, I've made my whole career on this volatility contraction approach. But again, this is just a perfect cup with handle. But it came off for a couple of days. You see here, 1, 2, 3, 4 days down, but that wasn't enough to have us hit our stop. So it held in there, and then it came back and it actually tightened up and actually improved. And this is something that you have to realize about a stock. It could, you could have a stock that's moving sideways and actually, as time goes by, it gets even better, and it morphs from maybe, a pair of queens, using poker analogy, to kings or aces. And this really started to look like aces right here. And I've recently made some comments on this stock, but it broke out, and you can see 1, 2, 3 days up. It only came down for 1 day, and then boom, right into new high ground. And that's a term that I call tennis ball action from natural reaction. And it's just holding up like a champ. I had sold this, and we actually scaled out of it a bit. I think the largest profit that I took was about maybe 17 or 18%. on this little move here, but still holding up real good. This has total canceling characteristics. You can see here, earnings are accelerating. You've got sales accelerating, and you've even got margins here that are improving in the most recent quarter, which is another thing I'll definitely got to give some MarketSmith some props here, because putting this information, the earnings, the sales, and the profit margins, where you can compare them like this for 4 quarters, is absolutely key. This is really all you need with growth stocks is earnings, sales, and margins, and it's all right here. So that's the benefit of using MarketSmith, and I've been using it for 30 years now. So this looks good. You know, it's definitely extended. I would not buy it here, but this is one that has worked.
Hey, and so Mark, let me stop you there for 1 second. Now there are a couple of things here. Now, where you first purchased it, on that day it was down, and then you were down 3 or 4%, but you didn't sell out because you had a plan. Talk a little bit more about that, because that is something that a lot of people are going to say, you know what, I'm out of this. And they're going to miss it, and they're definitely going to miss the next part of it. Talk about calling an audible and sticking to your plan.
So I think the audible side is really the best part of the point, you know, that you're making here, is that, okay, if you go into it and your plan is to cut your loss at, say, I don't know, the previous day's low, or
fair enough,
2%, okay, that's your plan. Then you've executed your plan. But if you go in there and you're saying, okay, this is the technical level that I'm going to set this at, in this case, it was this 83.48 level. That's where I would have deemed that this chart soured, if you will. So if that risk is acceptable when you make that decision originally, well, then you should stick with that plan and carry that out. And an audible would be to let your emotions come in, and all of a sudden you say, this is going to stop me out. I'm going to get out anyway. And then look what happens. Turns around, bang, takes off. You know, just a quick story. I've told this before, but I had one of my first assistants that I had back in the early 90s. We were in Stryker, and I had bought it breaking out, and it had pulled back, and it was back then we were in eighths. That was the smallest of the stock move. We were 1/8 of a point away from getting stopped out. And so he said to me, I'm going to sell Stryker here. It's going to stop us out. I said, well, it hasn't stopped us out yet. He says, yeah, it's going to stop us out. It's 1 tick down. It's 1/8 of a point down. I said, well, I'm going to wait until it hits that 1/8. I waited all this time. Why would I circumvent it now with only 1/8 of a point more? So he sold the stock. The stock never hit that 1/8, turned around, and I made a double on it.
Oh, man.
So, yeah, we've talked about this I'm still friends with him to this day. 30 years later, we still talk about it. So you know, again, you go in with that plan, stick with that plan, and then execute it, and then reevaluate it later on and see if it was a good plan or not, if you have to adjust it.
Do you ever do kind of a stop over time? Like if it's a number of days that have gone by and you're not making progress, so maybe you don't reach that level, but it just didn't do what you expected. Is that another aspect to this?
A stock not doing what I expected is, I do stop out with if it's not doing what I expected, but the chart usually is going to have to start looking abnormal. So if it doesn't do what I expected, but the chart still looks, it's still healthy, and I'm not seeing what I call violations. This is another thing you can read in my second book, Think and Trade Like a Champion. I show in there the violations and the confirmations. Once the stock breaks out, there's a number of things that I look for that are telling me that this is normal or this is abnormal. So as long as it's acting normal, and this was acting perfectly fine, coming off for a couple of days, there's nothing wrong with that. This is perfectly fine. It's still actually tightening. If you see, it's the pulling back, it's of course inside this 83.48. So you're tightening even more. So that's fine. As long as it's tightening up on the right side and you're not breaking down, then I would stick with it.
And what about Tempur Sealy, TPX as a symbol? You kind of had a similar situation, I think, with this one, if I remember correctly.
Very similar where it pulled back. So I bought this, just make sure I got the date right. I bought this one on 8/12, which is right here. So that right there. And similar to PAG, it pulled back right on the day where it broke out. It came in, which I call a squat. I don't usually let that squat knock me out unless their markets, something's going on, everything's breaking down, I'm having a lot of trouble. But normally even if it squats and comes all the way back down, I'm going to give it the full stop. So this pulled back. You could see it went inside for a couple of days, and then 1, 2, 3 comes in for about 3 days, but not enough to trigger my stop. And then it actually turned, it came back up. And then on this day right here, which is 825, I believe, right? Yeah, 825, I actually added to it right there. And then since I sold this stock, we actually sold the last piece, I believe yesterday.
Yeah. And any stocks that have kind of done that action where it broke out and then it just didn't work, and there have been plenty, but maybe you could show a few of those. You can show a few of those.
There's lots of those.
What you can kind of learn from them, and I guess this is the difference between, hey, the stocks that you just showed didn't break a rule, so they didn't get their time out, and get sold, as opposed to these where, hey, you did a violation, you're out.
Yeah. Well, I mean, of course, the first violation is if it hits your mathematical stop, your dollar stop, well, and then you're out. That's the ultimate violation. All right. So my violations, I'm looking for to see if maybe there's violations before the stop gets hit, and it's showing me it's not acting normal. And then I might reduce the position, or I might sell it if there's some ominous signs. But normally I'm waiting for my stop to get hit unless I'm seeing those ominous signals. In this scenario here, of course, this broke out right here. I bought it right here. So this is a pretty obvious one. You can see big cup with handle, tighten up right here. This has really perfect VCP characteristics. You had a really nice move right here where it came up that right side, and then it quieted down, and it was really just looking great. It didn't have earnings, and the Mars, you see, it doesn't have the fundamentals. So that right there, tells you it's of lesser quality. So I'm always on guard, but that immediately squatted. And then I see the next day, bang, it comes in, and then it just gaps down on earnings, and it went right into earnings. So it got out before even the earnings came out. The hope was for this stock to break out. Some people ask if I hold into earnings. We talked about that earlier, but I didn't discuss it as far as risk is concerned. If the stock broke out and I had a cushion, let's say the stock broke out and now I'm up 10, 15%. Then I'll go into that earnings report, and then I have some cushion to withstand a decline or a gap on the earnings report.
And maybe you could talk a little bit about FedEx, because this is one where you really kind of shifted your thinking on it from something that was looking okay to something that needed to be sold to maybe even something that needed to be sold short.
Sometimes we're in a name and we'll be long a name, and then not too long later, within a matter of a couple months or so, it'll be on the short list, and we'll be looking to short the same stock. FedEx was one of those. We're right here. Let's see the date on that. That was 527. Yep, 527 right here. I was buying it right here on 527 as it's coming into new high ground. This was just buying a little pullback. This was a little sketchy to begin with, because it wasn't coming out of a big base right here, although you did have some price action to the left here, but this was a little uncharacteristic for me. And then within a couple of days it came right in and just stopped me right out. But then you see it can't rally. And then it breaks right here on pretty good volume. And now it's trading below the 200-day. And then it can't rally there. It just goes straight sideways. And then on it was 913, which is right here. We put it on a short sale list right here on 913. And that's where I actually shorted the S&P, was on this, it was on 913. And since then it rolled over. And you can see, here's the real key. The earnings come out now, right? So you see the stock rolled over and it discounted this earnings report. This was smart money getting out of the stock before the earnings came in, and now you get the negative quarter.
So Mark, on that 913, why at that point did you start thinking, okay, maybe now's the time?
As far as the market, or as far as the FDX?
FDX to short it there.
Yeah, well, I didn't actually short this. We put this on our short alert list and just put it as an idea.
Okay.
I didn't actually short this stock, but I was seeing if it could. I was hoping it could actually bounce and it could spend a little bit more time and really start to get top heavy. And it didn't. It just kept going down. But yeah, I mean, just the fact.
So you just saw the continued weakness and.
Yeah, and it broke down in the relative strength. What I look for on the
Yeah.
short side is when you break below the 200-day and you can't rally, and then I look for the relative strength line to be hitting a new low, and
Yes.
that's where I start getting interested. And especially when you get an RS that, maybe it started off as 85, and now just
Yep.
a couple months later, the RS is 22.
Yep.
That's something that you should be starting to consider for a short sale.
Mm-hmm. Well, Mark, I really appreciate it. It just seems like there were so many lessons. So this might be one of those podcasts that people have to listen to over and over again. And if they want more of you, of course, you are sometimes a guest on IBD Live. I think your next appearance will be October 27th. And then, of course, there's the Master Trader program that's coming up in November. So they can have 7 days of you and a lot of your special guests. So, Mark, thanks again for being with us today.
Absolutely.
Hey, it was great being here. It's always a lot of fun. Thank you.
Okay. And on next week's show, we're going to have Nina Decca back on the show. She's a senior research analyst with Robo Global. And I remember listening to Arusha interview her last time, and I was just absolutely fascinated by a lot of the stuff she was talking about with AI and machine learning and everything. So we're really looking forward to having her back on the show. We hope you join us for that. And thanks a lot for listening. We'll see you next time. And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.